Welcome to your daily stock market summary from MarketSnap. Hey everyone, buckle up because today's market action was a wild ride, heavily influenced by geopolitical tensions and economic uncertainty. We've got a lot to unpack, from major index slides to standout movers and shakers, all while keeping an eye on the bigger picture for us long-term investors. Let's dive right in and see what's shaping the financial landscape. First up, let's talk about the major indexes. And folks, it wasn't a pretty day on Wall Street. The Dow Jones took a hit, dropping nearly 1%, while the Nasdaq saw a steeper decline of over 2%. The S&P 500 wasn't spared either, sliding about 1.5%, and the Russell 2000, representing small caps, fell into correction territory with a drop of over 2%. What's driving this? Well, the escalating conflict in the Middle East, particularly the U.S.-Israeli war on Iran, has sent shockwaves through energy markets, pushing oil prices up and fueling inflation fears. Add to that rising bond yields and fading hopes for Fed rate cuts, and you've got a recipe for risk aversion. Zooming out to the broader economic picture, the news is dominated by the Iran conflict. Reports are highlighting how attacks on energy infrastructure and shipping disruptions through the Strait of Hormuz are keeping oil prices elevated, even if they've stabilized somewhat today. This isn't just a short-term blip. Analysts are warning of prolonged regional insecurity that could keep energy costs high, stoking inflation, and potentially tipping us toward recession risks. On the Fed front, Chair Powell is holding steady with rates, signaling caution amid this uncertainty, while some Fed officials are even hinting at possible rate hikes rather than cuts this year. That's a big shift in sentiment, and it's got bond traders on edge. Now let's shift gears to some bright spots with the large-cap gainers. Despite the rough market, a few names managed to shine. Planet Labs surged over 25%, showing incredible strength, likely tied to growing interest in geospatial data amid global tensions. Energy players like Equinor and APA also climbed, benefiting from those high oil prices we just mentioned. It's a reminder that even in a downturn, there are sectors and companies that can capitalize on the chaos. For us long-term folks, these moves highlight the importance of diversification. Having exposure to energy or niche tech can hedge against broader market pain. On the flip side, the large-cap losers paint a stark contrast. Supermicrocomputer took a massive hit, collapsing over 33% after news broke of a DOJ indictment involving its co-founder and alleged illegal AI hardware sales to China. That's a brutal reminder of how governance risks can tank a stock overnight. Other names like Intel and Constellation Energy also saw significant declines, reflecting broader tech and energy sector pressures. Short-term, these drops might spook some investors, but for us with a longer horizon, they could signal buying opportunities if the fundamentals remain intact, especially with a name like Intel, which has a history of resilience. Checking in on the most active stocks, it's no surprise that Nvidia and Apple were among the heavy hitters in terms of trading volume. Nvidia saw a dip of over 3%, reflecting some investor caution despite strong AI demand, while Apple held relatively steady with a minor decline. These giants often set the tone for the tech sector, and their activity shows just how much attention is on big tech right now, even amidst market turbulence. For long-term investors, these names are often core holdings, but it's worth watching how geopolitical risks might impact their supply chains in the coming months. Speaking of market movers, let's highlight a few key players driving narratives today. Tesla also saw a drop of over 3%, continuing to face volatility as investors weigh delivery concerns against upcoming self-driving tech approvals in Europe. Bank of America, on the other hand, eked out a small gain, showing some stability in financials despite the Fed's hawkish stance. These movers underscore the mixed signals in the market. Tech is shaky, but selective strength elsewhere can balance a portfolio if you're playing the long game. Turning to the earnings front, it's a busy week with some big names reporting. FedEx just released results, beating expectations and raising their full-year outlook, which is a positive signal for logistics and consumer spending trends. We've also got Micron Technology posting strong numbers, reflecting continued AI-driven demand for chips, even if the stock saw some pressure today. Other notable reports include Accenture and Carnival Corporation, offering insights into tech services and travel recovery. For us long-term investors, earnings like these are critical. They give us a pulse on sector health and help us spot trends that could shape the next decade. You can find exclusive earnings transcript summaries on MarketSnap to dive deeper into these reports and what they mean for your portfolio. Looking at the top performers over the past week among large caps, Garmin led the pack with a stunning 21% gain, likely driven by strong demand for its tech products. Shopify and Occidental Petroleum also posted double-digit gains, showing strength in e-commerce and energy amid the oil price surge. These weekly movers remind us that even in volatile times, certain sectors can offer robust returns, something to consider when rebalancing for the long haul. On the other end, the worst performers over the week include Genuine Parts, down over 20%, and Rivian, slipping 14% as EV demand concerns linger. These declines highlight how quickly sentiment can shift, but for patient investors, they might present a chance to scoop up quality names at a discount if the underlying story still holds up over time. Wrapping up with sector performance over the past week, industrials topped the charts with a 2% gain, followed by consumer cyclicals at over 1.5%. Energy also showed resilience with a modest uptick, no doubt tied to those oil price dynamics. These sector moves suggest rotation into more defensive or commodity-driven plays, which could be a smart pivot for long-term portfolios looking to weather geopolitical storms. Conversely, healthcare lagged behind with a slight decline, alongside utilities and financial services showing weakness. This underperformance might reflect broader concerns about rising rates and economic slowdown fears, something to monitor if you've got heavy exposure here, though it could also signal a contrarian opportunity down the road. Stepping back, what does all this mean for us as long-term retail investors? Today's market turmoil, driven by Middle East tensions and Fed uncertainty, is a stark reminder that volatility is part of the game, but it's also a chance to stay disciplined. Focus on quality companies with strong fundamentals and don't get swayed by short-term noise. Energy stocks might offer a hedge right now, while tech dips could be entry points if you believe in the AI and innovation megatrends. Keep your eyes on inflation data and Fed moves in the medium term, as they'll shape the trajectory for years to come. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stay engaged with our daily updates and in-depth SWOT analyses to keep your investment strategy sharp. Hit that like button, subscribe, and we'll see you tomorrow for more insights to build your wealth over the long haul.